Hello viewers, join us on this video as we seek to enlighten you on the various types of economic indicators and also their implications in the larger financial markets. First, we have to explain that traders, economists, and investors continually keep their eyes out for signals that indicate the immediate future of the market and the broader economy. Typically, the focal points of this vigilance are economic or business statistics, which are systematically monitored from month to month so as to provide insights into patterns in the market or the economy. So perhaps you are wondering, what are these economic indicators that we are talking about? One thing that we say is that indicators encompass any statistics used to predict and comprehend financial or economic trends. Typically, economic indicators are usually categorized into three categories, which include leading indicators, lagging indicators, and finally, coincident indicators. Leading indicators anticipate future changes, while lagging indicators tend to move after changes in the economy have taken place and confirm patterns. On the other hand, coincident indicators occur in real time and help to clarify the state of the economy, or they clarify the present state of the economy. In markets or in the economy, the most closely observed indicators are usually social, business, and economic statistics published by reputable sources, including the US government departments. These indicators rely on regular surveys, which are typically conducted on a monthly basis and allow for tracking and analysis of results or statistics over a period of time. The impact of information provided by the indicators is highly significant in markets and the economy. It helps in shaping fiscal and monetary policies, influences business investments and strategies, and also affects the value of share prices. At the same time, the data that comes from these indicators is widely used by or in financial markets, including forex markets, among other markets. So let's look at the first category of indicator, that is the leading indicators. So it's worth mentioning that leading indicators typically constitute measurable datasets that help anticipate trends and forecast future economic activities. Some of the leading indicators include yield curves, new housing starts, purchasing managers index, index of consumer confidence, initial job claims, and average hours worked, among others. We have to enlighten that the yield curves are plots of yields, that is, interest rates of bonds with equal credit quality but different maturity dates. They are usually considered key indicators of economic direction. Typically, The shape of the yield curve can signal prospects for inflation, interest rates, and also the state of the economy. On the other hand, or the other leading indicator are new housing starts. Usually, if housing starts begin to rise, it means builders are optimistic about the demand in the near future for newly constructed homes. On the other hand, if housing starts begin to fall or fall, builders are becoming cautious. And that's a sign that home sales are slowing, or at least that builders fear they will soon begin slowing. Another leading indicator is Purchasing Managers Index. Purchasing Managers Index. Usually, the Purchasing Managers Index summarizes whether business conditions, according to the eyes of the purchasing managers, whether they are expanding, staying the same, or they are contracting. The number produced by the survey usually range from 0 to 100, with anything above 50 representing an improvement from the prior month. So another leading indicator that we have to highlight on is the overall money supply. We have to mention that generally, if there is plenty of money in the economy, or rather in consumers' pockets, in bank accounts, and also in bank vaults that are ready to be invested in businesses for expansion, it is a sign that the economy will be strong. It is a sign that the economy will be strong. So let's now look to the next category, lagging indicators. Lagging indicators can only be known after the event, but that doesn't make them valueless or useless in markets or in financial markets. We have to mention that lagging indicators help clarify and confirm a pattern that is occurring over a period of time. There are numerous lagging indicators that include an employment rate, corporate profits, CPI, labor costs per unit of output, and business indicators used for performance assessment, and also technical indicators used to understand market price movements. So we see, or we have to mention that the unemployment rate is one of the most reliable lagging indicators. Typically, if the unemployment rate rose last month and also the month before, it is an indication that the overall economy has been doing poorly and will continue to do or to perform poorly. At the same time, we also have to mention that the CPI, or the Consumer Price Index, which measures changes in inflation rate, is often another closely watched lagging indicator. So basically, there are usually few events that cause more economic ripple effects than increases in prices. As such, both the overall number and prices in key industries like fuel or medical costs are of interest to financial market traders, investors, and economists. So basically, lagging indicators, as we have seen, they play a key role in indicating or in clarifying and confirming a pattern that is happening in the economy over a period of time, and are therefore important for traders since they have to stay alert on what is happening in the economy. Such information will be paramount when they are making their trading decisions. The final leading or the final economic indicator category are coincident indicators. And basically, we have to mention that coincident indicators are statistical indicators that usually change simultaneously with general economic conditions. As a result, coincident indicators are viewed as reflecting the current state of the economy. It is worth noting that while leading indicators look ahead and the lagging indicators look behind, coincident indicators tend to reflect on the present or the very recent past. Some of the coincident indicators include the GDP, personal income, retail sales, industrial production, and personal spending, among others. So, as we have seen, there are various parties involved in economy and the markets all have interest on the direction or state of the economy. Or rather, the various parties that are involved in economy and the financial markets, they all have their interest on the direction or the state the economy is taking, has taken, or will take. We have enlisted the various parties, including investors, economists, policymakers, central banks, and corporate executives, all of whom are interested in the current state of the economy, and the direction that it might appear to take in the coming soon. This is because money and the well-being of the population are on the line, making indicators signals used to predict and understand financial or economic trends widely analyzed and highly influential. As a result, traders have also to pay a keen eye on what is being reflected by the various economic indicators to be able to make their trading decisions in a wise manner. So that if you are taking a long or short position, you have to understand what the economy of the specific currency is likely to be commanding the trader to be taking their position. So, for example, if the economy of the currency you are trading is weak or strong, then you have to understand how that might affect the movement of the said currency. Thank you for watching, and as usual, let us meet again in another video.